Well, the Fed feel they're perhaps at risk of doing a little bit too much. Risk assets rejoice. The recession trade's still very much there, but a data-dependent Fed seems to be the right Fed in the market's eyes. The world is solved. Get involved, says the market. We explore these thematics and more as we go into the trade-off. Well, hi, my name's Chris Weston, Head of Research here at Pepperstone. I'm going to be joined by, as always, by Blake Morrow from Forex Analytics. And we're going to be going through all the setups, all the thematics and all the news. And there is a lot of news, as there always is, to talk about and making sense of the craziness and shenanigans that are going on inside financial markets. So let's bring Blake into the show. Blake, my good friend. Couple of things. First of all, my collar keeps popping out. I feel like I'm John Travolta from Staying Alive. Just forgive me on that. I can't get it right at all. And it's really doing my head in.
There, Chris.
It's doing my head. I can't get it. Anyway, forget about that. The second thing is that I was thinking about you the other day. I saw that McDonald's had put up its burgers for the first time in 14 years, and I thought, well, if that doesn't sort of highlight inflation. Where are we? But the Fed comes to save the day. Burgers are going to be cheaper going forward. I thought that was just a really sort of a really amplified way of seeing the inflation story coming through in markets at the moment. What are you seeing?
Well, thank goodness, because my collar's sticking out now too. Thank goodness, because I didn't want to pay that much for McDonald's burgers anyway, especially the next time I visit the UK. So there we go. Yeah. Well, at least we got that in the news, Chris.
We did, mate. Let's actually talk about what the Fed have done, and you can put your collar back in, and we'll talk about some of the thematics that have been playing through. Let's go into Topical Thunder. Blake, thanks for doing that. Obviously, I'm looking a bit tired this morning because I was up at 4 o'clock, our time in the morning, to look at what was going around the Fed. We were thinking perhaps there was going to be some slight changes in nuance, but it wasn't particularly going to be a major volatility event. The market's seen this as dovish. The question, which we can discuss, is this sustainable? We've seen a positive reaction in equities. Gold prices have moved higher, bonds have gone bid, and you've seen the US dollar lower. For me, I'll just quickly take out a couple of things. First of all, the fact that they said they could look to slow the pace of hikes going forward. I think the market took that. And then I think specifically they said that the statement of economic projections, where they see the Fed funds rate at 3.4% by the end of the year, and they said they still see this as a guide that they're looking at very favourably, suggests that a 50 basis point hike in September is on the card. So it's settled that sort of 75, 50 basis point hike for the September meeting debate, and the market saw that. So the question is with the reaction that we've seen from the Fed, is this just a positioning adjustment from a market that was long of US dollars, and tomorrow could be a whole different factor, or do you think this has got legs?
Chris, first of all, I think it might have legs. I want to reference one of my colleagues. He put up the two statements side by side, and I'm going to read you just the first couple lines from the June.
Who's that?
1st.
Forex Flow?
One of our team members that is in the UK says overall economic activity appears to have been picked up after edging down in the first quarter. Job gains have been robust in recent months, and the unemployment rate has remained low. But today's statement said recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months, and the unemployment rate has remained low. So they changed that very first sentence in the paragraph, and what happened there is we saw gold rally, the dollar sell off, like that knee-jerk reaction, but then they started to hold until we got to the presser. Now the Fed Chairman Powell, he said he got to the point where he said we're in neutral. Now if I'm going to use a car analogy, does that mean he's coasting in neutral and we're going to be coasting at the same rate, or is he in neutral, he can slam it into reverse and then really screw up his clutch? I'm not sure how to read him.
Well, they're going to go. They're going to go harder. They're going to be data dependent. That to me is the most important thing now. So they've changed the mantra that they are now firmly data dependent, and we can talk about that in a second in data review. But for me, that's a really important thing. For me, what happened, Blake, is the market had a pricing mechanism in its mind and a theory and a school of thought that was going to happen throughout the rest of the year and into next year. And I think the Fed have shared that view. I think the Fed have said, we're on the same path of what you were thinking. Market feels validated, and they feel relief on the back of that.
Yeah, well, and I had a trader reach out to me and ask, like, hey, Blake, what do you think? Is the Fed chairman going to really affirm that that they're going to continue to fight inflation?
Wow.
And when that didn't come out, we saw that reversal in the dollar. And that's why I think it might have some legs. We've seen a very small pivot, right, in the Fed.
Yeah, a little
Everybody's expecting some sort of pivot, but this is like a little one, I think.
Little one.
So anyway, well, let's talk about the dollar's reaction today, because the dollar got the smackdown. I want to just mention a couple of things about the dollar. I still think we're in a really strong uptrend. So when I say, is the dollar really doomed, I think we're still in a strong uptrend. And I have to reference that the dollar it's not just a dollar story. I know today was a dollar story, but we're still look at the ECB. And I have to say, I can't look at the euro right now, Chris, and say I really want to be a buyer. That's like the last thing on my list in the currency market I want to do.
That's right.
But that doesn't mean that I don't want to sell the dollar against other things.
That's right.
I think the Aussie dollar looks good. The Kiwi looks good. The Canadian actually looks pretty good. Some of these commodity emerging market currencies. So I want to ask you this, Chris. After today, do you feel that the dollar's doomed? I think that's a little premature. But what do you think?
I agree. You're not buying the Aussie dollar because you think that Australia is a great place to keep your money. You're not buying the Kiwi dollar because New Zealand's going to be raising rates and it's looking relatively more attractive as an investment destination. You're buying the Canadian dollar, the Aussie dollar, the CAD, the Aussie, because they are vehicles to express a view. That is a weaker dollar, builds commodity prices, and it's just a risk-on semantics vehicle. That's all it is. Euro is slightly different, though. I just, apart from positioning that needs to come out, short euro dollar positioning that comes out, you're still looking at BTP Bund spreads that are widening. You're still looking at a gas story that's really, really precarious and only going to get worse, in my opinion, in the short term. There's no reason to be buying euros. We've seen massive outflows of European equities, and maybe that's a buying opportunity. But from a currency perspective, there's just little to like. The pound, the pound's trading fairly closely correlated with the euro, but they've got political issues that need to be resolved. I think that there are places that will benefit from a weaker US dollar, but you're not buying those currencies because you're actually taking a favourable view on the central bank. You're doing it because you're an expression of a weaker dollar leads you to go and buy high beta plays and a risk on semantics, right?
Yeah, I think that's exactly it. And so that's the way I wanted to make sure I framed it in such a way, because am I playing the dollar to the downside? I have been for the last couple of weeks, but I'm really particular about where I'm playing the dollar, right. And it's not one shoe fits all feet.
I want to say this well that the Fed still are fighting inflation. I'll give you the Fed, I'm going to get some sticky tape and just stick it there. But the Fed are still fighting inflation. They're just data dependent, right? So if the data still comes in really strong, they're still going to raise 75 basis points in September, right? The market seems to think it's going to be 50 basis points. But if that next inflation read is super hot, if the inflation expectations turn higher, then they'll raise 75 basis points. I don't think anything has necessarily changed, but the fact that they are open to the idea that it could be less, I think is what the market's looking for, because some of the data has been a little bit softer. So, just coming out at that point, look, I don't see a collapse in the dollar, but the moment they actually come out and properly pivot, which could come out after September, will be the time when you start really selling dollars, in my opinion. So what do we look at? Let's have a look at data review, because a Fed that has become data dependent means that what you're going to see is bad data being bad for the dollar, right? So we're now in that frame of mind. We've been talking about this in the show for a long time. So bad data now means we sell the dollar, and you probably do it more so against the Japanese yen, probably, in my opinion, and the Swiss franc. So what are we looking at? Well, the big one's on the 10th of August. That's my time, the 10th. Probably you're the 9th, you're 11th. And that's the next CPI number. And that's going to be really important. So the 10th of August for us, big number CPI. Obviously, we're hoping that's going to be a little bit lower. And then that could give the Fed reason to raise rates 50 basis points. Next week, we get the ISM manufacturing number. I think they're really important. Services ISM number, again, very important. manufacturing numbers, specifically after what we saw from the S&P Global, which showed big contraction there. Next Friday, we get the payrolls number. We're obviously looking at wages. We've got jobless claims, which have started to sort of meander higher. On the 9th, just the day before CPI, we get unit labour costs. So how much is effectively it costing a business to get each unit of productivity out there? And on the 17th of August, we get the retail sales numbers. So the point being for me, Blake, is we manage risk as traders, right? So the fact is, when we're looking at that economic calendar, we now know that the Federal Reserve have just shown us being data dependent means that the market is going to be much more sensitive to data. We're going to see bigger changes in rates. We're going to see bigger moves in the dollar over those announcements. So we're looking at those data points and saying, what is the Fed looking at specifically that's going to frame their next decision? And that's why I think you're going to see implied volatility in the FX market slightly higher. So these are the dates that I'm specifically looking out for. But yeah, that 10th of August CPI number is going to be large.
And that's going to be a big one, Chris. And we have, don't forget, we have months, like 2 months worth of data. Like we're going to literally have 2 months worth of high volatility moves in the currency market and markets in general. If you thought this was going to be some sort of like lackadaisical summer, I don't think that's what it's going to be from here on out.
Because what is that word? Is there a fact check? Can you?
That lackadaisical, folks, pull it up and Google it. Yeah. Wikipedia that bad boy.
Thesaurus.
But people thought that hey, that we're gonna have summer trading and it's gonna be lackadaisical, Chris. That it's gonna be just kind of like ho hum. But no, we're gonna have some volatility, and I'm gonna be paying attention to the jobs report. And I know CPI is obviously big. We want to CPI. I won't argue with you. That is the key data point. But remember, it is the Mac Daddy. But the Fed is now starting to look at jobs data, and it is becoming very important. They reference it that the jobs are still plentiful and it's strong. So if we start to see weakness there, you have to be really careful with owning dollars if we start to see employment data.
I just want to sort of on your word lackadaisical. Just remember like the FOMC don't actually have a meeting in August. So you talk about this period of time, but we do have the Jackson Hole Symposium coming out in late August. So it won't just be that we're going to have Powell speaking. We're probably going to have a whole plethora of Lagardes and Baileys of this world coming out. So we will get a chance for them to understand what's going on. And I don't know what the title of the meeting is at the moment, or the symposium, which is another word you only use once a year, and that's at Jackson Hole. But yeah, just forget, we don't have a Fed meeting in August, but we do have Jackson Hole playing through.
Don't be lackadaisical, Chris. So let's take a look at commodities. Let's talk about commodities a bit and the commodities market, because I was looking at the Thomson Reuters, the CRB index, and we've had a substantial rally since like the COVID lockdowns. I mean, it's been nothing short of massive and astonishing. But there are a lot of people that believe that we are going to be in a high inflation environment for a very long period of time. And if that's the case, then I got to start asking the question, are commodities a good buy down here? And we're starting to see commodity currencies like the Australian dollar, the Kiwi dollar, the Canadian dollar, they're starting to look a little bit perkier as of the last few weeks, which most of you, if you've been watching here on the trade-off the last couple of weeks, that we've been kind of queuing off of those stronger commodity currencies. Well, commodities look like they've had a decent pullback, and that CRB index has had a 24% Fibonacci retracement, which it's not one of those retracements that I look at a lot, but when you're in a strong trend, it means that it's a very shallow retracement if that's all we're going to get. And that's kind of what I'm seeing right now. So with this weakness in the dollar, Chris, and with what happened with the Fed, the perkiness of risk assets, even cryptocurrencies rallied pretty substantially today.
Yeah, they did.
Do you believe that right now is the time to be a buyer of commodities? What are your thoughts?
Well, remember the CRB is about 40% weighted towards the crude price. So I think you've obviously keep an eye on that, and that's had a decent bounce. We've had a bit of a bounce after about a 30% sell-off in gasoline that started moving up. Something Biden will be talking about. Absolutely. We come back to the central point. It's really about what happens with the US dollar. I think equities, commodities, they all are looking at the US dollar. The dollar is just pivotal to everything. Going to Asia, Asian equities, certainly, Cosby and Japanese market, very, very influenced by what's happening in the dollar. And the dollar is just central. It's right at the epicenter. If you get yourself a cheeky Venn diagram, it's right in the middle of, affecting everything. So you tell me where the dollar's going, and I'll tell you where commodities are going. But also look at China. Now, China still isn't opening up as much as we'd hoped. And obviously that's because they've still got the COVID zero issue. Liquidity in China has been moving up, but again, not to the same extent that we probably would like to see in system liquidity. So I think China's the elephant in the room when it comes to commodities. So we need to understand what's going to happen with the dollar. We also need to understand what's happening with China economics. We are starting to see signs that maybe they're going to open up a little bit more, but we really need that. If they were to open up, then I think commodities go up. So I think the commodity which really gets me at the moment is gold. I'm seeing signs that, if we say we don't like any of these currencies right now, right? And you don't like euro, pounds, and if the dollar was to give up, then I think gold becomes a currency in its own right and actually becomes quite attractive in that situation. At the moment, we haven't given up on the dollar, and that's why gold prices aren't really going up as strongly as we'd hoped. But I think the moment the market gives up on the dollar because we get a true pivot will be the time that gold really goes up at the moment. So interesting one there. Right. Anyway, let's go to, that's the setup. Have a look at some of the charts that are making news. Mr. Comedy Blake was talking about Ethereum a minute ago, and I want to bring up the chart of Ethereum there because we did see that moving up double digits last night. So generally speaking, when you get a weaker dollar, when you get the kind of Fed coming back a little bit, stepping up a little bit, you do get risk assets moving up. And of course, we know that crypto is the highest beta risk asset out there. So we did see some big moves up there. But what we've seen with Ethereum there, Blake, is obviously we've held the 50-day moving average, which is the blue line, which is starting to sort of move sideways now. If I have a look at my momentum indicators, the 3-day relative to the 8-day, that started to turn higher. So that's positive. We can see the rate of change, the 5-day rate of change has started to turn positive. So there's a bit of momentum to go through that. I like this as a momentum trade, but we need the breakout. The breakout is key for any kind of momentum into a potential trend following situation. But we're right on that ceiling now. So we've got that consolidation high. The reason I've put this out there is because for me as a sort of a momentum trader, the momentum indicators are there. Does this now turn into a trend? And with trend following, you just got to go along for it. You're not trying to anticipate. You just see it there, and it could. What will be will be. But a break of this ceiling, which we're seeing around 1608, I think is something that I want to be involved with as a trend. What are you seeing?
Well, first of all, I'm going to spin my lackadaisical opinion on ETH and understand there's some sort of merge that's happening that's got a lot of bulls re-engaged right now in Ethereum. I think that line that you have that's drawn around the 1700 level, that breakdown point, that's a big one. But the 38% retracement comes in around 1925. That's kind of a key level that I'm looking at, because if we can get above that, then I think you might actually get some momentum higher towards the 2000 level. But look, I wouldn't want to be on the short side of that. It looks like a kind of a cup and handle pattern, if you ask me.
Yeah. So. Well, this is one that I'm not long, but when the market tells me and pushes me into it, because the flow of capital is all aggregated into one thing, then I'm in. But this is one that's on the radar. I've got the alert set. When it breaks out, I've just got to be involved in that as a momentum, potentially a trend following trade. So let the market push you into the trade. Let it compel you. We're not there yet, but this is one that has to be on the radar.
Well, I'm glad that you brought that up, because I think it's one that if you're a momentum guy or gal and you start to break out like that, I know how you like to buy those breakouts. So that's big. I'm going to take you over to the DAX, and this is going to be called the DAX attack. Now, I tell you, I'm sorry, I know it's corny. Yeah. I was going to talk about the DAX a couple of weeks ago when you had the guest from TradingView on, so I didn't get an opportunity to talk about the DAX, but I like it off of those lows. You can see those highlighted lows of this yearly lows. But we have this divergent relative strength. We're setting up a bull flag pattern. Yep. And I'll tell you, bull flag patterns are continuation patterns, and it's something that I like as a setup. The first level resistance that we're going to push up against is going to be around 13,300 or so, but the 50-day moving average comes in just around 13,500, 13,470, somewhere around that neighborhood. We break above that, and I think you got to be looking for a DAX attack, like a McDonald's McTack. I don't know. Anyway, what are your thoughts about the DAX here?
Well, again, I mean, these markets, these indices, it hurts. It hurts to be long. It feels wrong, doesn't it? It just doesn't feel right. You buy it and you chastise yourself. But the fact is, we've got to be open-minded about it. And when the price is the final arbiter of truth in every situation, especially when you're trading with leverage. So if we get a breakout, you've just got to be long there. I mean, the 50-day is great for mean reversion traders. They love to have it as a trend filter. So I think a break of that would be quite positive. But with Germany, there's still so much to hate. You've still got so much leverage to what's happening in Nord Stream, and that's only going to get worse.
That's a good point.
In these situations. The inflation issue is a problem. It's going to get worse with the weak euro. So it's difficult to like that. But, a breakout, these bull flag patterns, about 80% of the time they break out in the direction of the former trend. So, if that does break out, you've got to go along with it. You've just got to be open-minded. We talk about it time and time again. We can hate everything about Europe right now from an investment perspective. But if price tells you to buy, you've got to go along for the ride, right? Otherwise, you're going to miss out in that situation. Yeah. So, I like. And
that's what makes us. That's what makes a setup, right, Chris?
It does, mate. Absolutely. I like the way you bring that in. Bringing it full circle and switching it over stateside. A similar sort of situation we've got with the US500. This is a chart that I've been looking at. I brought out to clients yesterday. We've got this descending wedge pattern that has now broken out to the upside. It needs work. And again, just buying US500, buying the Dow, buying the NASDAQ, it feels wrong, like we're going into a recession in the US, we're going into a recession certainly in Germany, certainly in Japan, parts of Asia. The world is going to recession. We've just seen the IMF coming out and cutting their forecasts as well. Central banks still raising rates. The dollar's still pretty near its highs. So buying equity is just a horrible trade. No one likes to do it. But it's going up. And at what point, Blake? Right. I mean, we've just seen it poke. This needs work. Will it start trending? That's what I want to see. So I take a positive bias for now until we can get a failed break back below that 39.10. Earnings are coming in at the moment. They're pretty strong relative to consensus. Earnings are always strong relative consensus. But this is going up just like the DAX trade, mate. What are you thinking?
Well, it is like the DAX trade, and I agree with you in exactly what you're saying. But I've got to say there's a really key level that I'm looking at. It's the 4,100 level. That is actually the 38% retracement. You hear me say that again. The big 38% Fibo retracement from the all-time highs to the most recent lows of last month. That comes in right just sub 4,100. Also, the 161% extension of this last consolidation that you can see on your chart, that also comes in at 4,100 or right around there, within 10 S&P points of that. So I think that's going to be a big pivotal area for the market. So can we get some upside? Sure. When we get to 4,100, I think that's when you really have to start protecting your trade, moving your stops, watching your risk, paring down your position size. But hey, look, I think there might be some upside between now and then. I mean, that's 80, 90 S&P points. That's not little chump change, right, Chris?
Well, we could get some FOMO coming through. We'll see what happens.
We could.
And of course, there's so much stuff that you've got to go and speak to the flow desks about, the hedging activity that's moving down. You've got vol targeting funds dripping into the market as the VIX comes lower and realized volatility comes lower. So there's a lot of shenanigans that takes place in this market as well. So again, open-minded. If it feels wrong, it's probably the right trade.
There you go. That's a good way to frame that love. One. All right, I'm going to take you over to the 10-year U.S. notes. And I'm going to say it's a setup. It's a Post-it note. Put a Post-it note on your desk and say, look, we have an inverted head and shoulder pattern that is setting up. But, Chris, this is where I'm going to defer to you here in just a minute, is I'm going to want your opinion on this because I'm trying to figure out why bonds are going to rally. I mean, are bonds going to rally? If they do rally and we stage a breakout, and by the way, the breakout that I'm looking at on these notes would be right at the 121 level, just above 121. But if you're trading like the 10-year yield, it's going to be if the yield drops below like 2.70, 2.69. But if that happens and you see a rally in bonds, what would do it, Chris? What would actually spur a squeeze? I think we could squeeze back to the 200-day moving average at least in this setup if we break out. But what would produce a move in the bond market? Is it going to be risk off? Is it because recessionary fears? What are your thoughts?
Well, at the moment, it's the move that we've seen in yields going lower. Prices, you can see, has moved higher. has really been driven by inflation expectations, the inflation expectation element of the nominal treasury. So when you're looking at nominal treasuries, effectively you've got expected growth over that period, average expected growth over that period, you've got inflation expectations, and then you've got term premium, how much you're going to be compensated to hold a fixed income instrument for that length of period. And all the move so far has been driven by the inflation expectation element of what creates the yield there, the expected return. So I think inflation expectations, if commodity prices were to turn south, then maybe that's going to be partly down to the strong dollar. Then I think price goes up in there. So I'll be looking at that. So keep an eye on break-even rates, keep an eye on commodities, keep an eye on the dollar. If we get a further stronger dollar, if we get commodities lower, then bond yields are going higher, in my opinion. So I'll be looking at inflation expectations specifically there, Blake. Yeah, for sure. Anyway,
right.
Let's.
Thank you, Chris.
Every day's a school day, Blake. Let's go to play of the day. Let's have a look at what's going on in our mind. Going on in mind. Put me off, mate. Well, funny man Blake and I have been discussing a lot about what's been happening with the Aussie dollar today, and it's going to actually conveniently be my play of the day. And a lot of this will depend on really what's happening with the equity market. So if that S&P continues to go up to some of the levels Blake's was talking about, then I think the Aussie dollar is going to go up at probably a faster clip. We can see it working nicely in with a channel. We can see that the 3-day exponential moving average is moving away from the 8-day. Obviously, that's just since what we've been seeing with price. But really, when price falls, you can see it cushioned at the 8-day. That's been the line that's really holding on the situation. And until we get a break back below that sort of 68.77 level, which is the black horizontal line you can see within that channel, I think that you take a long bias, and I think we continue to work higher within this channel into 71 cents. So that's where I'll be putting my stop loss. I know there's a reasonable amount of risk there. Obviously, it's a swing trade, but I like this higher, and that's conditional, obviously, that commodity prices are working, the dollar weakens, and equity markets are higher. And I think the Aussie dollar is shaping up quite nicely. I think we've seen a bullish outside day engulfing. It might not work, of course it might not, but at the time, everything is showing me that the distribution of probabilities is that it's skewed towards a higher Aussie dollar here.
Well, I'm going to keep with the theme of the Aussie, and I'm going to show you guys the Aussie Kiwi. Well, and you notice the headline, it's Kylie Minogue.
If you just pull like a random Australian out, just like you could have done Russell Crowe, who would have mixed both worlds there.
So first of all, this is a nod to all the Forex analytics community. Most people know that we nickname some of our currency pairs. Aussie New Zealand is fondly named Kylie because Kylie happens to be my favorite Australian singer of all time, and I love her to death. And thank God my wife isn't listening right now. But we have other nicknames for other currencies like the dollar Mexican pesos, Salma Hayek, and the David Beckham gets thrown out for the ladies sometimes. So anyway, going back to the Aussie Kiwi, we have a big breakout because the pair has been holding above a big breakout point, a 7-year trend line that's highlighted in red. We've been consolidating above that for like a couple of months. And we just had literally a month-long consolidation. We started breaking higher, and now it looks like we're going to make a move to 112, maybe even as high as 113 with Kylie. So I like the Aussie Kiwi here, and I like the Aussie with you.
Good stuff. Well, thanks for all your jokes and humour today, Blake. It's been good fun. But obviously a big day. We've just seen the Fed meeting coming through. We've got to keep an open mind. We've been looking at the DAX, the US500, the dollar specifically. And while we have seen a bit of a turn, in my opinion, from the Federal Reserve, the question is will it be sustained? I'm not so sure it will be, but certainly the market feeling validated here. So again, thanks to everyone who's watching this. Give it a like if you can. Drop your comments as always. We'd love to hear from you. Last week there were some fantastic comments. Anyway, next week we'll be back for more of the trade-off.